everyone. I am absolutely thrilled to guide you through today's explainer. If you've been dreaming of finally stepping into the real estate market, well, you're in exactly the right place. Today, we're laying out the ultimate roadmap to American homeownership. We're calling it our Mortgage Explained for Beginners Guide, and we're looking specifically at the landscape in the USA for 2026. We're going to dive into the high definition, super high quality details of this whole process, taking what usually feels like a giant financial puzzle and turning it into a really clear, confident path forward for you.
Okay, I want you to imagine something for just a second. Picture yourself finally buying your absolute dream home. You get the keys, you walk through that front door. It's literally perfect. But what if I told you that one single tiny mortgage mistake could end up costing you over $50,000 in extra interest over the life of your loan? Yeah, no way, right? Well, that $50,000 is exactly why we're here today. Before you sign on the dotted line, you really need to understand the nuts and bolts behind a home loan so your dream home doesn't secretly turn into a financial nightmare. So, here's our roadmap for today's explainer. 1. The high-stakes mortgage basics. 2. Prepping your finances. 3. Choosing your home loan. 4. The pre-approval process. 5. Beyond the monthly payment. And finally, 6. Smart tips for buyers.
All right, let's jump right into Section 1, the high-stakes mortgage basics.
Simply put, a mortgage is just a loan used to buy a home. Instead of paying the full, massive price of a house upfront in cash, which, let's be real, most of us simply cannot do, you borrow that money from a lender. You then pay that borrowed amount back over a long time, usually 15 to 30 years. And in exchange for getting you that capital up front, the lender charges you interest. It's really not just a one-off transaction. It's a long-term financial partnership that's going to dictate your wealth-building potential for decades.
But as much as we all love talking about dream homes, we have to look at the sober reality of the stakes here. If you fail to keep up with your mortgage payments, the lender actually has the legal right to take the home back through a process called foreclosure. The house itself is the collateral for the loan, so every single detail of your budget has to be meticulously planned. Having a sharp, crystal clear picture of your finances is absolutely non-negotiable if you want to protect your investment. Which brings us to Section 2, prepping your finances.
Step 1 of getting your finances ready is the down payment. That's the cash you pay upfront when buying the home. Now, there's a direct kind of seesaw relationship between what you pay today and what you're going to owe tomorrow. If you make a larger down payment upfront, it usually means you need a smaller loan. And that smaller loan, it leads to lower monthly payments and significantly less interest paid over time. On the flip side, a smaller upfront payment means you have to take out a larger loan, resulting in higher monthly payments and way more interest in the long run. The math here paints a really vivid picture. Your upfront cash directly alters your long-term reality. Building right on top of that down payment is step 2, your credit score. This is hands down one of the biggest factors lenders look at because it basically acts as your financial resume. It proves how reliable you are. A stronger credit score improves your chances of qualifying for a loan in the first place, and, crucially, it helps you lock in a lower interest rate. A weaker score? Well, that reduces your chances and pretty much guarantees a higher rate. And here's the massive takeaway. Even a tiny fraction of a percent difference in your interest rate drastically changes the total amount you repay over 30 years. Actually, that's exactly where that $50,000 mistake we talked about earlier usually hides.
All right, moving on to Section 3, choosing your home loan.
When you're choosing a loan, you're going to hit a major fork in the road with two main options. First, you've got a fixed-rate mortgage, where your interest rate stays exactly the same for the entire life of the loan. Your principal and interest payments are totally predictable. You're basically buying ultimate peace of mind, knowing exactly what's due every single month, no matter what the economy is doing. Alternatively, there's the adjustable-rate mortgage, or ARM. With an ARM, the interest rate can actually change after an initial fixed period. Since that rate fluctuates with the market, your payments could go up, or they could go down in the future. So it's really the ultimate choice between rock-solid, long-term stability and potential short-term flexibility. Let's look at Section 4, the pre-approval process. Okay, listen closely on this one. Before you ever step foot into an open house or start scrolling through online listings late at night, you need to follow a very specific order of operations. Step 1, get pre-approved for a mortgage. Why? Because of Step 2. It gives you a concrete estimate of how much you can actually borrow. That establishes your true hardline budget. And Step 3, getting pre-approved shows sellers that you are a serious buyer. You aren't just window shopping. You've got the verified financial backing ready to go. You absolutely have to secure this advantage before you go falling in love with a property you might not be able to afford. Next up is Section 5, beyond the monthly payments. Owning a home is about so much more than just paying your mortgage every month. And honestly, failing to plan for the full scope of costs is where a lot of new buyers get financially trapped. Your mortgage is really just the core expense. You also have to budget for property taxes from your local government and homeowners insurance to protect the place from disasters. Then there's the inevitable maintenance and repairs, because let's face it, eventually the water heater is going to break or the roof is going to leak. Add in your daily utilities and maybe homeowners association fees if your neighborhood has an HOA. The point is, your monthly mortgage payment is only a fraction of the total financial weight you need to carry every single month.
Finally, let's wrap things up with Section 6, Smart Tips for Buyers.
To really protect yourself in your financial future, I want you to follow these golden rules. First, always compare offers from multiple lenders to make sure you're getting the absolute best rate. Loyalty to one bank rarely pays off here. Second, buy a home that fits your personal budget, not just the maximum loan amount a lender approves you for. Just because they'll lend you the money doesn't mean you can actually afford the lifestyle. Third, keep an emergency savings fund fully intact for when life throws a curveball. And finally, read every single loan document carefully before you sign anything. These practices are literally your armor against devastating financial traps.
I want to share a quote that I think sums this up perfectly. Buying a home is one of the biggest financial decisions you'll ever make. Understanding how mortgages work can help you avoid costly mistakes. The gravity of this entire process really cannot be overstated. Being informed, staying deeply focused on the high-quality details, and taking the time to truly understand these mechanics is exactly what separates a thriving, happy homeowner from someone buried in unexpected debt. So, I want to leave you with one final, provocative question to reflect on today. Are you buying a home that truly fits your budget, or are you just maxing out your maximum loan amount? Remember, long-term financial safety and peace of mind should always take priority over maxing out your debt just to get a slightly bigger house. Thank you so much for joining me today as we unpacked this essential guide. Keep learning, keep planning, and I will see you in the next explainer.